Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning. Welcome to Morning Call. I'm Latha and with me are Anuj and Surabhi. Well, there was a reason why we played that montage. That is going to be the big story of the morning and perhaps of the day, dominating mindspace, business as well as stock markets. Well, we are starting on a very sound note. So the wave of risk on that we saw maybe 2-3 weeks back, which appeared to have ebbed, is now full on. No two ways about that. Yes, along with that risk on, crude is also higher, which may make for a minor underperformance of India. But still, the direction clearly is that risk appetite is in full swing. For India, I think the more important story, as the montage indicated, would be the GST. The cuts, probably forced and arm twisted by the government, may be a minor negative for FMCG companies, but my sense is that it would definitely be made up by volume. What we're really getting from the government is, as Sushil Modi indicated, that revenues are getting more robust. I mean, I think Timsi Jaipuria even filed a story yesterday saying that, the third month, it's a third high in terms of tax returns. So that, as Mr. Modi indicated, will mean, and I mean Sushil Modi now, indicated that will mean space for further cuts and further simplification. So my own sense is that, there are fundamental reasons why the markets can rejoice. Bond yields again yesterday stayed put after that RBI cancellation. So, minor negatives perhaps, but ultimately I think there is enough tailwind in this market. Of course, I leave it to Anuj to tell us whether yesterday the resistance can be easily taken.
Good morning, Latha. Absolutely take your point, particularly on GST. And I don't want to get ahead of myself, and there's enough analysis going on out there. But somehow the headlines are beginning to sound right on GST, whether it's the tax collections, as you mentioned, the returns, the number of returns being filed going up month on month. And if you look at the previous months and the revisions that are coming in, even those numbers are moving higher and higher. And I was speaking to a couple of tax experts with a very simple question, that after the revision that we got last Friday on those 178 items, are things now finally going to get cheaper? I mean, pre-GST tax rates versus where we are in that 18% bracket? And the answer is yes. A lot of products, shampoos, detergent, body wash, etc., they seem to be even cheaper, and the government is quite clear that you need to pass this on. So I don't know, don't want to be euphoric, but perhaps maybe it could be a bit of a small fiscal stimulus on the consumption side, because this is being passed on. Just one additional thought point, the consumer insights arm of WPP, and these guys really understand consumer, one would imagine. According to them, the rural growth is really looking much better than even the urban growth at the end of Q2. They've compiled data across companies, and there is about a 13-14% increase in rural India. That's FMCG, plus some of the autos put together. So overall consumer, perhaps looking good. So Anuj, we've been sort of narrating a lot of these positive cues, both Latha and me. The question is it going to be enough ammunition for the bulls? Because yesterday, they seemed like they were losing the momentum at least a little bit.
Morning, Surabhi. You know what? The bulls didn't need this narrative, honestly speaking, because, it's a bit of a deja vu. Remember, we spoke about it post-demonetization, and I still remember talking about it on the GST day, and when the GST correction happened, that would be the best time to buy. And you will see, as a country, we normally see this happen. Negative voices are raised, but, the economy somehow, finds its feet, and, triggers come later, and the market rally. That's one reason the market is at, the levels it is, and not at, say 9,200 or 9,300, because it knew that, some of these moves will will get sorted. But, I just want to present the near-term picture. Yesterday, remember, I spoke about 10,350 being a bit of a line in sand. And in that sense, it was a bit disappointing for the bulls yesterday, because yesterday was as good a time as any to really press home the advantage, and the bulls failed to do that. So a close about 10,350 is crucial, because that would mean a lot of short covering is likely once that happens. But as of now, the thesis is clear that the correction is over, and the 50-day moving average is now 10,100, 150 is now your floor for the market. FI selling has resumed, but so has DII buying. And I think the best the market has done is when the FIs are selling and DIIs are buying. So I don't think bulls would complain about that. There's just one technical point that I want to make. I could be wrong here, but that's my understanding. HDFC is going through some selling pressure, and that's a stock which is corrected a lot, while HDFC Life is surging. I don't know whether it's, some investors just want to play the life insurance part of HDFC Life. Yesterday also there was 400 crores of buying, delivery buying in HDFC Life. I think we saw something similar play out in ICICI when Prudential and Lombard got listed. Of course, after that, it got sorted, but that for me is a bit of a issue because HDFC is, the bank nifty is at all-time high.
Stock.
Exactly. The bank nifty is at all-time high. Mid cap is almost there. The nifty is not there because of a couple of stocks like HDFC. So that's just one stock that I would want to keep an eye on. But mid cap party is on, and today the index could make a new all-time high. It fell by about, fell short by about 10 points yesterday. It could do that today. And one more point. The reports that the BJP is regaining the lost ground in Gujarat, and yesterday with the self-goal scored by the Congress, I think that could be a big trigger for the market. And once that happens, I think the next expansion phase could take the Nifty to 10,800 to 11,000. That's been the template of this market. One step back, two step forward. And I think two step forward would mean 10,800 to 11,000.
10,800. Well, we're, 160 points away from our all-time high. So let's see how and when that happens. Quickly now to run you through some of the calls that we are getting this morning. Manishi Ray Chaudhary of BNP Paribas believes the intense policy action of the last 15 to 18 months should soon bear fruit, possibly from second half of FY19. His focus is on three main themes: domestic consumption, resilience of the global commodity recovery, and the robustness of retail lenders. In addition, he's relying on the recovery of a few stocks that have underperformed severely but could benefit from industry consolidation and company-specific strategic challenges. Their topics include HDFC Bank, IndusInd Bank, Infosys, HCL Tech, Bharti Airtel, Z Enterprises, Dabur, Maruti, Eicher Motors, Reliance, BPCL, and Petronet LNG. Interesting list, mix of consumer, some IT there with Infosys, and of course lots of oil and gas.
Okay, more opinion coming your way. Mahesh Nandurkar of CLSA says the key message from the 20th India Investor Forum is that investors believe the worst for corporate earnings has passed. He says investors also like the government's pro-growth stance visible in the PSU Bank recap plan and mild fiscal relaxation through the tax cuts. He says companies highlighted the shift from unorganized to organized is moderately visible, but improvements in capex activity are not expected just yet. CLSA's preferred compounding stories are in housing theme and in private banks. Their preferred value cyclical stories: ICICI Bank, SBI, M&M, ITC, Lupin, RIL, Bharti, Jubilant Food. Well, broad overlap.
Okay. Well, on that note, let's move to the money market action now and get you some views there. Pramit Brahmbhatt of Veracity says the rupee will float in a range today in the absence of any directional cues. He is expecting the spot USD INR pair to be in a trading range of 64.80 to 65.20 for the day.
Okay, there was a mild underperformance by the dollar. Dhaval Dalal of Edelweiss says the bond market sentiment has improved dramatically after RBI's cancellation of its open market sale. He says the 10-year benchmark bond yield has declined by around 16 basis points to 6.9. Adds market participants are debating the next course of yield movement amid focus on macroeconomic parameters, demand-supply dynamics, and prospective introduction of the new 10-year government bond. In his opinion, the fair value of the 10-year benchmark bond yield is between 6.75 and 7. Well, that's not saying much. That's where it has been. But just a couple of things. All these GST price cuts feed into the CPI. So if there are fears because of crude, these fiscal giveaways are also going to be a bit of a help for the CPI. The bond markets, therefore, will not give up that 6.9 citadel. I expected Dhaval Dalal to include that as well. The price cuts are important from a CPI point of view.
Absolutely. Okay, then let's head across to Nigel to get a view of the world. And it's a rather green morning, Nigel, isn't it?
Indeed, it's a great morning. If you just take a look at what happened in the US markets, they ended with good gains in trade yesterday. The Dow and the S&P, both of them ended high with gains of around 0.7%. But the Nasdaq did better. That ended with a gain of around 1%, telling you that the tech-heavy index did do well. What helped it? Apple. That was the big boy in there that put in a strong performance. And that really helped both the Dow as well as the Nasdaq. A few more stocks should come up for you. Facebook did very, very well. Netflix did well. And Amazon as well did well. Remember, there's a holiday season that's coming up. And maybe that could spark off higher volumes of them. And that explains why, in fact, all these three did well in trade yesterday. The VIX, Anuj has been tracking that. That continues to drift lower. In fact, yesterday it was at its lowest close that we've seen in the last couple of weeks. The US economic data as well is looking fairly good. We had the Chicago Fed National Activity Index. That rose higher than expected. We also had the new home sales data. That as well looked quite good. So both those two data points look quite good, telling you that the economic data is looking up out there. If we move to the European markets, well, they were doing well yesterday. All the three frontliners ended in the green. The DAX, that's the one that someone would thought that maybe, in fact, the coalition government, Angela Merkel's coalition government is not working out. But that, in fact, did end with good gains. So it's brushing aside all that news. In the European markets, we had the auto stocks that did very, very well. Volkswagen came out with their midterm outlook on both profitability as well as revenues. That stock ended higher. And Porsche, that's owned by Volkswagen, that as well ended with gains of around 2 to around 3% yesterday. Asian markets looking good. Keep an eye out on the Hang Seng. That's crossed the 30,000 odd mark. So the stage is set. Green on the screen. The SGX Nifty is indicating we should open up in the green. Back to you all.
Thank you very much, Nigel. And I think an important point, despite the turmoil in EU's biggest state, Germany, and the question marks over the return of Angela Merkel, European indices couldn't care less. I mean, they go on. Well, but let's return back home. The big story this morning, 4 months after the rollout of the GST, some green shoots soon after the government's warning to companies to pass on the benefits. We have the first set of price cuts. Sapna Das caught up with the lady of the moment, as it were, the CBEC chairperson, Vanaja Sarna. She chatted about the letter that Ms. Sarna had written to the FMCG companies and whether now the warning is going to be extended to restaurants as well.
After the Guwahati meeting, a whole host of, I would say, items have been reduced in duty. So the focus was basically the consumer. So I wanted to make sure, and the government wanted to make sure that whatever the decision was taken by the GST Council gets passed on to the consumer, because that was the whole purpose of the reduction. Therefore, I wrote this letter. And even before that, the finance minister had been appealing to industry. In fact, the revenue secretary has also been saying so. And I just said it in the form of a letter, and I thought, let me address the top 100 odd, industries in this area, just to ensure, and all I wanted was a little assistance. So mine was more in the form of an appeal that, and this, a lot of people have asked me that, do you think this is interfering in pricing and interfering in the company? It's not like that. The idea was that the FMCG guys, we're all in it together, wanting to allow the consumer to get the benefit. So it's really work together. And that's exactly the cooperation I've been asking for.
Ma'am, any other sectors that you'll be covering or you'll be looking at as of now, ma'am?
I've already written to some restaurants as well, and I plan to write to some more as well, especially the bigger chains. But here again, we, get these odd, and all of you would have got it, you get these WhatsApp messages about the way the rate has gone up, or when duties come down, why are we paying more? So again, just to sensitize everyone that I know that you've had an ITC before and you may not have it now, but your rate has also come down substantially. So some way the consumer has to see that benefit.
Ma'am, are you going to look at any kind of a benchmark over here? Because, how does the industry know that this is how much the benefit has to be passed on? Because, they'll have some cost of their own, like rentals, etc., or even dealer margins. For example, manufacturing, the electronic sector will say that, we have done the needful as a manufacturer, but then the rest is a dealer chain and so on and so forth. So how do you ensure this? What is the benchmark? Will you be looking at benchmarks like up to 5%, up to 10%? Because your letter says very clearly that the benefit that is to be passed on should be commensurate with the rate reduction.
Yeah, absolutely. I mean, there is a rate reduction. There are so many elements as far as the manufacturer is concerned. But with all those add-ons in terms of value addition at every level, companies know best how this gets marked and priced. They know it already even before we have reduced it. They know the way people operate. They know the dealers' margins. They know the wholesalers. They know what the retailer finally. They know what their product retails at finally. So taking into account everything, I would think that as an FMCG company, I would like to be concerned about the fact that this benefit should go to the consumer. And if it means that I have to keep a little bit of track about the in-betweens, I need to do that.
Okay, so it's green on the screens as far as Asia goes and on the SGX Nifty. And of course, we have plenty of specific stock action to look at. There's the SGX Nifty about 30 points higher. Plenty of stock specific action this morning. So let's straight away get down to our stock list of the day. Good morning, guys. Thank you for joining in. As always, Anuj, I'm going to start with you. What's on your radar today?
So, before that, the SGX Nifty, I think that's it will be interesting if we open above yesterday's high. That I think would be the key for this market, because yesterday also Hang Seng was up 900 points and today it's added another 200 points. So I think the Asian bull market has sort of resumed its uptrend, and I think that could be an interesting bit. So you could focus on a lot of stocks today. Hang Seng, in fact, now up 300 points. I think the stock of the day for me today could be Mirza International, because there's this report of leather package or footwear sector package. We spoke about this a month back, and it's rallied a bit already. There's Bata as well, but then Bata is in F&O and such a large stock, and it's rallied a lot. So Mirza could be interesting. It was up 8% yesterday though, and it's a stock which is at crossover of 20 and 50-day moving average, and strong delivery buying as well. So that for me would be the stock to watch out for in today's trade, at least for first few hours. The other interesting stock that I picked up is Cox and Kings. I first checked if there was any block deal. I couldn't find any, because yesterday there was 8 times jump in delivery volumes of Cox and Kings, and it had a strong bounce from 20 and 200-day moving average. It's corrected about 15% from its peak, so would be interesting to see if there's any follow through in this one.
Fair point. I read about the leather package coming, but it seemed like it is for small-scale industry. I don't know whether Mirza will benefit because they source it from them, but yeah, it's quite possible that the markets will play it that way. But the markets are definitely going to play the FMCG and restaurant stocks one way or the other. We heard the CNBC chairman, but Mangalam, break it down in stocks.
Absolutely. I'll speak about stocks, but it's a consumer story. I'll be very honest. All our FMCG daily provision bills for hair care, body wash and all of that will go lower. The prices of that, and a large part of that can also be attributed to the admonishing that the CBEC gave to the government, to the FMCG companies rather. So Dabur and HUL, ITC, all of them have come out and spoken to the people and the press and said that they have effected price cuts to the tune of 8 to 10%. In Dabur's case, Marico too has cut their prices on the products that matter, the likes of hair gel, hair creams, etc. HUL, they've been at the forefront of GST price cuts and price rationalization, which is why they saw market share come by in the last quarter too, and they remain committed to passing these price benefits to the consumers. ITC too, a large part of their portfolio is cigarettes, but the FMCG bit, they have cut their prices. What does this mean for individual companies? Well, it could be a bit of a positive, given the price cuts that have happened are primarily the GST pass-throughs. So there is no real money that they are paying from their pockets. The Dabur as well, they said that they had, it won't impact their margins, but it will in fact spur demand going forward. So that could be a bit of a positive. But what could be a negative is the fact that because they have cut the prices, they won't get the benefit of that additional margin. But that was in the anti-profiteering law as well. Now what? The focus shifts on the restaurants. The government has cut the rates from 18% to 5% with the removal of input tax credit. So that has caused a bit of confusion, where the restaurants have increased the base price and still maintain that the effective price is lower. So those stocks I'll be watching out for. They could be under a little more pressure, but the FMCG stocks, expect them to be in the green.
Okay, yes. Some restaurants have passed on the benefit. Right. Let's not paint all of them in the same brush. I think the ones with pricing power, like McDonald's and all, maybe not, but the local eateries have done that. But anyway, let's move on. Anisha, NCC, why are you watching out for that?
Well, a positive news coming for NCC and BGR Infrastructure, as the consortium has won a mine development and operations order from NTPC. The project value is over 25,000 odd crores and needs to be completed over the next 25 years. Now, the revenue potential of this order can be 1,000 crore per annum. The first batch of coal should start coming out by FY20. NCC has a top line of around 8,000 odd crores, so this can add around 5 to 6%. When you look at the 50% share that the company has, 51% share that the company has in this JV. But remember, if you look at the stock from October itself, the stock has surged over 20-30%. So it should hold up in the green, but the upside might be a bit limited. Back to you.
Thank you very much for that, Anisha. Ronit, we understand that the TRAI, the telecom regulator, has proposed some easing of rules for spectrum.
Yeah, so the TRAI has basically said that they're planning to raise the spectrum limit for an area from 25 to 35% for merged companies. So this is positive for the likes of Idea and Vodafone. Also, they're saying that they also suggested removing the 50% limit on individual spectrum such as 700, 800 megahertz. Instead, for a combined spectrum, they're expecting a 50% limit for companies. So this is positive for the likes of Reliance, Jio, as well as Idea, Vodafone. This will allow Jio to capture more airwaves from Reliance Communication going forward. So on the back of this, you can expect some green on the telecom stocks going forward.
I guess it really helps spectrum trading, sharing, and all the consolidation overall that we're seeing in the sector. Thanks, Ronit, for that. Sonal, an FIR against the PVR promoters. Why?
Absolutely correct, Surbhi. So the Gurgaon police has been asked to file an FIR against the PVR group because Elan Group has alleged that the company has cancelled all the real estate agreements that the company has entered into with that real estate provider. Why is that happening? Because the company wanted to overprice its shares when it sold 14% stake to Warburg Pincus. Now remember, in January 2017, Warburg Pincus had bought 14% stake for rupees 820 crores. So that is the whole reason why the company has been asked to file an FIR, but PVR says that Elan had misrepresented the facts when they had entered into the MOUs, and that's why they were cancelled, and they are seeking a legal advice in this regard. So, but sentimentally, I expect a red tick on the stock.
Okay. Well, it sounds like a legal wrangle, so either side could be right. Let's see if PVR really indicates any impact of this news. But to wrap it all up, Naveen, which are the other stocks we should watch?
Well, Latha, I'll begin with the leather stocks, which you and Anuj already discussed. There are reports which are suggesting that there will be an incentive package for the leather companies. Remember, this is for the smaller companies, so we expect the likes of Mirza, Relaxo, as well as Super House Leather to be in focus. The other being Team Lease. That is one stock that I'll be clearly watching today. Remember, the global asset management company T. Rowe Price, they have bought in 5% in the stock yesterday via a block deal. The sellers were Gaja Capital. Remember, these were the early investors in the company. On the other hand, CSE Motilal has come out with a note on CSE, and they have a buy rating on the stock with the target price upwards of 20% from the current price at around 1360. The two key things that the brokerage believes about the company, one being that they have got the 185 megawatt PPA signed for their Flexi coal project. On the other hand, the demerger that the company is looking for, that will be unlocking value going ahead. On the other hand, Saturn Credit Care will be in focus on the back of issuance of securities that the company is mulling on the 24th of November via a board meeting. Remember, this will be the 5th issuance of shares in the last 15 months for the company, but nevertheless expect the stock to be in green in today's trade. Back to you.
Okay, all right, thanks so much, Naveen, for that. Let's quickly recap our list for the morning then. Stocks that could see some green today include Dabur, ITC, HUL, Marico, Specialty Restaurants, Jubilant Foodworks, Westlife Development, Mirza International, Cox & Kings, NCC, BGR Infra, Idea Cellular, Reliance, Relaxo, Superhouse Leather, Team Lease, CESE and Saturn Credit Care. Well, the lone stock from our list, which could actually be in negative territory, is PVR because of those legal issues that have cropped up.
Okay. Well, yesterday at a function organized by McKinsey, we had a whole range of India Inc. heavyweights speaking to us. We had Uday Kotak and Rajneesh Kumar, the two big bankers, speaking about consolidation in the banking sector. And we had N. Chandrasekaran, the chairman of Tata Group, speaking about India's GDP growth prospects. Just listening to a range of voices from India Inc. We are back with our technical experts.
I think consolidation in financial services will happen because of needs of efficiency, because of needs of having management teams which can manage risks. A 250 basis points cost of intermediation, and maybe it's because of compliance, maybe it's because of obligations like CRR, SLR, the kind of asset pools we have. There are lots of reasons for it, yes. But the marketplace is not going to give that luxury. And that is where I think you're going to see a significant consolidation, either through combinations or mortality.
You can define world-class in many ways. But if we are talking about the size, then definitely the gap between State Bank of India and the next bank, it is very huge. And if the consolidation has to happen, and if we are talking about the size, then you can't achieve it by consolidating a smaller bank. Then only when the large banks, they come together and merge, only then you can create a scale which is anywhere close to State Bank of India. So the next bank in terms of size is less than 1/4 of State Bank of India.
The issue is not whether we will grow at 6%, 7%, 8%. If you grow at 6%, it takes 32 years. Can we do it in 20 years? And it is not that uniformly you'll grow at 9% every year. I think it's like you will have a good day, you'll have a good year, and you will not have a good year. So if you can manage to grow at an average 6, 7% and have a few good years, then it can happen.
So if I look at China and India, if you look at the last 20 years, India is grown at about 5.5%, and our per capita GDP is now about $1,800.
Yeah.
China is about 5 times our size in just hard GDP. And India needs to grow on a per capita GDP of about 8% a year for the next 20 years to reach China's level of per capita GDP. And this is per capita. Therefore, if you take a population growth of 1 to 1.2%, for the next 20 years, we must grow at 9% to reach the current GDP of China. And that, I think, is our challenge.